Hi, this is Charlie Aitken of InvestmentMatters.club. President Trump was tweeting again this week, blaming the recent global stock market sell-off on China, accusing the second largest economy in the world of debasing its currency for trade advantages. The majority of financial experts seem to agree with him, but are they right? Before we get to that, let's remind ourselves of a recent overview called The Billionaire Wimbledon and the Yen for Gold. It reminded that financial instruments, including currency pairs, move in well-defined fractal patterns, not linear as most human beings tend to think. The patterns provide great clues to where the British pound or the dollar yen goes next, and you can bet your life it'll have nothing to do with either Brexit, politicians or central bankers, wherever they are. The dollar yen is a far more important currency pair than pound sterling, with wider implications for global bond and stock markets, plus the ultimate currency hedge, the price of gold, which incidentally is inversely correlated with the dollar yen. Hence it explains why the price of gold had been moving higher of late as the yen strengthens against the US dollar. Returning to the Donald's outburst on the Chinese currency, let's have a look at a longer term picture. And this goes back over a decade, since just before the global financial crisis. And really it's been a game of two halves. For 6 years from 2000, the yuan strengthened against the dollar. Since when it's actually weakened. I'd like to also bring to your attention the 2017-18 correction of this weakening, remembering that financial instruments are fractal in nature, to note that the correction achieved is a typical 78.6% of this period here, the weak patch. We will revisit this Fibonacci ratio later within the presentation. Zooming into a slightly shorter period, over the last 5 years, I'll put a red line here, which is when President Trump was inaugurated as the US President of January 2017. And we can see again here, it's been a game of two halves. Stronger yuan, followed by a period of, well, actually, the turn came in 2018, coincidentally, just as President Trump started the trade war, since when it's weakened. Also, it's interesting to note that over this whole period, the relationship has only changed currency-wise by 2%, hardly manipulation. As for any effects on the global stock markets from this currency relationship, let's take a look. By adding the Dow Jones World Stock Index to this upper panel here, that's the blue line, which is a size-weighted market index, about 50% driven by the US stock market, one can note a loose inverse relationship between the world index and the dollar yuan currency pair, whereas a perfect inverse would achieve -1. It is currently running at about -0.5. So what guidance can we take from this analysis? Well, before we answer that, let's return to the decade-long dollar yuan chart that was shown earlier and add the Fibonacci ratio tool once again, as mentioned earlier, but from a different start and end point. This time we'll take it from 2008 down to the 2014 end of the yuan strengthening period. And we're interested to note that where we are now is at 78.6% of this move here. Hence we are approaching a very important juncture, or we're at that juncture. Interesting times indeed. So there we have it. As stated within the current investment time and solution explainer video, it's of paramount importance to not only watch the main stock indices, but to have a reliable, cost-effective toolbox at hand to confirm and act on the natural twists and turns. You can look at that through the link. It's equally important for guidance on currency pairs, including the dollar yuan. Fortunately, we have a toolbox for those as well, plus for currency pairs not mentioned. And as can be seen from the earlier chart, the timing signals have been pretty good of when to be in the market, out of it during the neutral periods. So perhaps it's time to remove the guesswork offered by the many experts, inverted commas, and consider a solution where the results speak for themselves. So let's finish it there by showing the obligatory health warnings and of wishing you safe investing. Goodbye for now.